proceeds from.
Right. And we'll get to how this all flows into Gap and Dell and HP and Peloton and Workday. But first, Steve Leisman has Cleveland Fed President Loretta Mester. Morning again, Steve.
Carl, good morning. Thanks very much. We are joined by Loretta Mester, the Cleveland Fed President. Loretta, thanks for joining us this morning.
Thanks, Steve. Great to be with you.
Yeah, let's talk where those guys kind of left off, which is this idea of the next steps for Fed policy. And I guess the test that you guys have put off is this test of substantial further progress on both sides of the mandate, inflation and employment. So tell me, are we there yet?
Yeah, well, Steve, thanks for pointing to the forward guidance we gave, because that's the way I look at policy and where we are. So I'm comfortable that we are basically there. I think on inflation, you can make a very good argument that we have made substantial further progress. In fact, we're well over 2% at this point. Some of that won't last, but some of it might. And we've also made a lot of very good progress on the employment side. We still see the number of jobs lower than it was in February of 2020 before the crisis hit, but we've certainly made substantial further progress since December when we put that forward guidance out. So I'm comfortable that we're basically there. And now it's a question of communicating what the policy stance is regarding our asset purchases and making sure that we do it in a way that is well forecasted and well telegraphed, so that the Powell has been doing and the whole committee has been doing is making sure that we communicate our policy stance, where we see policy going, and our outlook.
So you're on national television with a free rein to communicate where that policy is going. Tell me about your thoughts about when this taper process ought to begin and how long it ought to go.
All right. So thanks, Steve. So, I'm comfortable if we begin to talk about, what our plans are in September, and then we start tapering sometime this year. I'd like to see those asset purchases taper down so that they're completed by the middle of next year. I think there's no urgency that we do it. I think we're in a good spot with regards to where the economy is. We can talk about Delta as being a risk to the outlook, but right now I think the asset purchases, we just don't need the same kind of accommodation that we needed at the height of the crisis, and I'm comfortable that we've met our conditions for, as we articulated the forward guidance. So tapering to start sometime this year, tapering to, asset purchases to end middle of next year.
Loretta, would you mind talking about the evolution of your thinking about inflation? When we spoke in June, you weren't all that concerned. You seemed to suggest that you weren't sure if this was permanent. It looked more transitory to you then. A couple months later, has your view on that changed?
Well, I think that permanent transitory probably isn't a good way to explain my views on inflation. What I'm looking at is whether some of those COVID-related increases in prices, and we've seen that in a number of places, some of the supply constraints, whether they're going to linger enough and stay on long enough that they actually get embedded into inflation expectations and then become an higher inflation on the underlying trend inflation, those core inflation measures that, if you will, that we'd like to look at to sort of give a sense of where the underlying inflation rate is going. Right now, all of the people I talk to and businesses are saying that, we thought that those supply constraints were going to ease off by now. And now it's all changed, that they see those kind of supply conditions and higher prices, their input prices, lingering until next year or even later in some cases. So I think those higher prices in some of those components will stay a bit longer than we originally expected. And that could feed into inflation expectations in a way that is not consistent with our 2% mandate. So that's what I'm watching, is whether those kind of one-of price increases become embedded in people's expectations about prices continuing to rise. That's where I think we'll have to really take a hard look to see if that's happening. So far, we've seen some increases in measures of underlying inflation, but we haven't seen that be sustained. So again, I'm very watchful on the inflation side. And, your original question, has my view changed? Is yes, the evidence suggests that some of those higher prices could linger for longer than expected.
Do you feel like when you say you will take a hard look, do you anticipate now that inflation may need to be addressed by raising rates sooner than you expected?
Well, not yet. I mean, my baseline outlook is still that inflation will move back down as some of those, supply constraints ease. But I think it's up in the air now about when that timing will be. I'm concentrating now first on sort of the asset purchase part of our policy. If we complete that by the middle of next year, then we'll be able to sort of take a look at what the incoming data suggests about the strength of the economy, both on the employment side and on the inflation side. And then we'll have time to assess when that first rate increase would be appropriate. But right now, the focus in my policy is on what to do with the asset purchase program. Then we can consider raising interest rates at the appropriate time. And again, I'll point out that I'm going to be guided by the guidance we gave in our statement, that we continue to give in our statement about what those conditions for that first rise in the interest rate would be, which is, inflation at 2% and moving above, and employment at our maximum employment mandate. So again, the forward guidance really is guiding where my policy views are.
But back in June, you gave a speech about the need to, or your suggestion that we need to incorporate financial stability into thinking about the setting of monetary policy. Beyond the theoretical ideas in that paper, I want to ask you about the situation right now. Are you concerned that we have issues of financial stability that are made worse by what's going on with a wide open Fed policy and the amount of liquidity it's put out there?
Well, we've added a lot of liquidity, but some of my concerns about financial stability are longer run issues in terms of, do we have the kind of insights we'd like in the non-bank financial sector? We saw those disruptions in the treasury markets that really necessitated the Fed to move in very aggressively at the start of the pandemic because of some of the issues in the treasury market and some longer, underlying issues in sort of how the treasury market functions. So I think those are the concerns I have now. I do think that, we have frothy real estate prices. That's an area where I'm, looking at. I don't think there's a bubble necessarily, but I do think that the liquidity that our asset purchases are adding are not helping necessarily that situation, and they could be adding to further frothiness in that market. That's something I'm looking at. And leverage, especially in some of the markets, the junk bond markets, is high. And so again, not really at a point where monetary policy has to react to it, but something I'm going to be watching.
I was just going to ask, does that motivate your desire to begin this taper and remove some of the accommodation the Fed is providing, the idea that you have concerns about the frothiness in some of these markets?
Not really. It really is being driven by looking at the macroeconomy and how far we've come since we said the forward guidance in terms of substantial prices. We've made very good progress in the labor market. Some of the problems in the labor market now are supply related, not demand related. I can tell you that many across all sectors in the 4th District, which is where I'm from, all the firms are saying it's very hard to get labor. So that's a supply side. There's some mismatching in the labor market. And on the inflation side, we're well above 2%. If you look at a backward-looking 5-year average, inflation and core inflation, PC inflation, are above 2%. So again, we've met the criteria just on the macro side for wanting to start that taper.
Loretta, we only have a few seconds left. I want to ask you very quickly. It seems like it's implicit in what you're saying that you do not have concerns that the Delta variant and the way it's spreading around the country are going to dramatically undermine either the economic progress we've seen so far or your forecast for growth in the months ahead.
Yeah, I mean, Delta is certainly a concern. I mean, it's a public health concern. And as we've seen in this whole pandemic, what happens with the economy depends on what happens with the virus. I think things are a little bit different now because we have the vaccination. And so, I'm hoping that everyone gets vaccinated because that's our best defense against Delta. The firms in my district, I've talked to them, we do a lot of outreach. There's a lot of concern about Delta. There's some tapering, maybe pushing out a little bit of some of the plans they had to bring their staff fully back into their offices, but it really hasn't changed their outlook. They're still, seeing strong demand out there. And at this point, that's my forecast as well, that nothing is smooth. Everything is up and down. But we've learned to kind of navigate the virus. And I think that's really been true across businesses and households. I think we've learned. But again, the vaccination is the key here to making sure that we can maintain the progress we've made over the past several months.
Loretta Mester, thank you so much for joining us this morning. Next time, I hope we do it in Jackson Hole, but this was just great. Thanks very much.
Thanks, Steve.
Carl, back to you.
Steve, thanks for all your hard work leading into this weekend, bringing us so much important commentary. That's our Steve Leisman. It was interesting, guys, to listen to Mester talk about the notion that these supply constraints could linger for a while, because think about just this week, Toyota's chip supplier saying this could last through 2022. Cisco last week, Taiwan Semi hiking prices 10%. It all feeds into the micro as well as the macro.
Absolutely. And it's not something that's very susceptible on either side to Fed policy, turning of the dial. But it definitely would keep the inflation readings elevated beyond what they're comfortable with. If you did look at the inputs in the latest reported this morning, PCE inflation numbers, it still does look like a lot of reopening effects. It's still restaurants and hotels largely. Still the auto issue is kind of creating that overshoot versus longer-term trends. So there's still the ability for Jay Powell and everybody else to say, look, this stuff is going to work its way through to some degree. And that's why I do think, she said, look, we're basically there. That was her quote. So how Powell kind of reacts to that will be the interesting.
Right. We'll get through some of the corporate results this morning. Maybe we'll take a look at some of the eco data. And, of course, Powell speaks just after 10 a.m. Eastern Time. Futures green on this Friday. Don't go away.